Right, joining us now for more, Jay Woods, Freedom Capital Markets, Chief Global Strategist. What do you use this info for, and who do you pay particular attention to?
You pay attention to the big names because that's what moves markets. That's what the street's watching, the Teppers and the Berries of the world, Leon Cooperman, Ackman, Icon, but it's a lagging indicator. I mean, this is from 45 days ago, so this is what they did in the fourth quarter, but it's always interesting to see the trends because that's what people follow. Some people like to follow that herd mentality and they'll ride the coattails of these big names. I mean, as a young investor, I followed Warren Buffett and I bought Coca-Cola because Warren Buffett bought it. So that's one thing. And then you look for the overall market sentiment. Are there sectors they're getting into or getting out of? The Mag 7 is going to be scrutinized, but that rotation was kind of just jockeying. There were no big new positions. Then that's the last thing. Look for new positions. There were two that struck me. Looking at Michael Burry and looking at Appaloosa Tepper. They both got into HCA Healthcare. That was an interesting one to me, and Oracle. So those are the things that people will watch. And then there are always these diamonds in the rough. NVIDIA filed a 13F today.
Oh, you're a NVIDIA guy.
NVIDIA guy.
Okay.
Yeah.
All right, because it's NVIDIA, NVIDIA. You think it's interchangeable?
Well, listen, if you own it, it doesn't matter how you say it. You're just happy you have it. But they even filed a 13F. And watch, you talk about diamonds in the rough. There are two stocks in that 13F filing that are up 60% in the pre-market. And NOX, Nanotechnologies, and Soundhound, SOUN. So you're going to see people jump into these things, even though these positions are 45 days old or older.
In general, what's your Freedom, since you're running the global strategy? What's happening? What's the macro backdrop look like?
Well, the macro backdrop, in relation to the 13Fs, it didn't really tell us anything like there was a big change. I like the fact that there was some more rotation into healthcare. The macro backdrop is we've come pretty far, pretty fast. We're 10% above the 200-day moving average in the S&P 500. A pullback is normal. And I think that's what we're about to have. I think after this last CPI reading and the FOMC meeting, remember 2 weeks ago when we sold off 1.5% with the FOMC, it was a big deal. We slowly made it back. I think the CPI number is a little bigger of a deal where we'll struggle to make it back as we go into that March meeting. So I expect us to kind of chop sideways. Seasonally, it's also a weaker time. So I don't expect us to make new highs until after the FOMC speaks in March. But that doesn't mean we're going much lower. A normal 5% correction is healthy in these markets.
What's better for the markets if the economy continues to stay on track like it is now and earnings therefore come in better than expected, or the economy slows a little and the rate cuts come back on the table? What would you rather have?
Well, right now it seems like we're in a good spot. The stock market's making all-time highs, so the Fed can kind of stay back and stay higher for longer. Not that they're supposed to follow the stock market or anything like that. But, the numbers are coming down. We didn't meet expectations, but they're still trending the right way. Earnings have trended higher slightly. Yes, it was a lower bar, as you mentioned. But I think things are progressing slowly. If we get a cut unexpectedly, that to me would kind of be a danger sign. Why are we cutting? It would be nice to see a quarter-point decline and get it done before the election cycle starts, so we don't make this a political issue. But I think they're going to
quarter-point. We were going to get 6.
I don't know where that number ever came from. I was always in the 3, maybe 4 camp. 6 was something that was priced into the market, but the market's still holding on pretty resiliently. It's impressive.
So you don't see the labor market and wage gains. You saw the Senate race out in California, right? Mm-hmm. $50 minimum wage. Because the living wage in California is $104,000. So I don't think they're serious about that, but there's still going to be wage pressure. Will the last mile, as people are calling it, getting to 2%, will that be more increasingly difficult? Could you foresee another rate hike in the next
hike? I'd be surprised. You'd have to see jobless claims like spike out of control right now. And that's the one thing we watch week to week, that Thursday jobless number. We still haven't gotten to up 3.9% unemployment. That was our peak. The low is 3.4%. if we start thinking about recession calls and bringing that back on the table, we're going to need to see unemployment tick to 4% and get a 0.5% off the low for 3 months of the SOM rule, if you're following those little indicators. But right now, it's not going to be a soft landing. There's going to be turbulence, but we're smoothing. We're sailing at a nice altitude right now. Higher for longer, yes. Maybe we cut in May, as Powell boringly says every time. We're data dependent, and the data hasn't said we got to cut just yet.